Good morning, everyone. Welcome to this week's Phillip Securities Research Morning Call. So as usual, we have a few stock counter update. We got JPMorgan, Bank of America, Wells Fargo's first rate. We also have some macro sector outlooks, US semiconductors, Singapore Air Transport monthly, Singapore rates monthly, and SG weekly. Last but not least, we have our technical analysis. So just a usual disclaimer, it's solely for educational purposes. So I pass my time to Iqbal to start on the US semiconductors. I guess we move on to Glenn first, US banks.
Yeah, thanks, Helena. Yep, we'll start with the US banks then. So the three banks that we cover, released their results last week. Along with all the other banks as well. So we'll just do a quick review and the recap of the banks. Yeah, next slide. Yeah, so we put the four biggest US banks here just to do a review, and a comparison, I guess, of their results. So if you look at this, you can see that their net interest income, the second line here, has been, it's dipped quite a bit, or inched up a little bit in the case of Bank of America. And this is sort of to be expected as the rates cuts start to come in more. For the non-interest income, this was really what helped them to have a good set of earnings. So it was up, it went all the way up to 60% for Citi and 30-something% for JPMorgan and Bank of America. And this really came from the continued recovery in the investment banking as well as the asset management. Trading also improved quite a bit. So the other positive sign we have seen is that the provisions change has been pretty, at least provisions have been pretty stable, right? It has only gone up a little bit, or even declined a bit for some of the banks. So that's a good sign, showing that the provisions and allowances have not crept up too much, even though credit card debt has been increasing steadily. Loans growth has also been quite stagnant, mid low single digit kind of loans growth. But if you look at the bottom graph, the bottom table, the red box here, you can see that the earnings per share, or EPS, has gone up quite tremendously for all of the banks. And this is really due to a good set of non-interest income growth, but also the fact that the expenses has improved quite a bit, mainly from the absence of the FDIC special assessment. So this is a review of these four banks. Now we'll dive into the banks that we cover. So we'll go into greater detail. We'll start off first with JPMorgan. Yeah, so JPMorgan's their fourth quarter earnings jumped by 50% year-on-year to 14 billion, and this was slightly above our estimates, with their earnings, their full year FY24 earnings at 103% of our forecast. So a brief sort of overview and highlight of their results is that they recorded higher asset management as well as investment banking income, and at the same time expenses and provisions have also dipped, which was offset slightly by their lower net interest income. For the positives, like what I mentioned, the investment banking revenue has continued to surge, mainly from the investment banking fees, from higher fees across all their products. As for their asset and wealth management, we have seen the higher average market levels as well as strong net inflows and higher performance fees have led to the growth in management fees, resulting in this strong revenue growth that we have seen. And for last positive is that their provisions have also finally dipped. So we have seen that the net charge-offs, while it has increased, the net reserve build has actually went down, which has led to this provisions dipping by about 5%. The main reason for the net charge-offs increase was from the card services or credit card net charge-off, which has risen slightly. As for the negatives, net interest income and net yields have dipped slightly, mainly due to the lower rates as well as deposit margin compression across the bank, and also lower deposit balances in the consumer and community banking. The adjusted expenses, so if you exclude the absence of the FDIC assessment, so it was 2.9 billion in the fourth quarter of 2023. If you exclude that, non-interest expenses has gone up by 5%, but it's mainly due to higher compensation costs as well as their front office and technology staff growth. As for the outlook, we will touch firstly on their common stock repurchases. For FY24, it has risen by 90%, so it's quite a huge jump up, the amount of stock repurchases that they're doing. And this has surpassed their guidance, their previous guidance of 2 billion per quarter. So they only, guided for around 8 billion for FY25, but they hit 18.8 billion. So it's more than 100%, more than double of this guidance that they've given. As for FY25, they have not really given any guidance on the share buybacks, but mentioned that more capital return through buybacks is possible. So if we do assume that their share repurchase program is maintained at the current pace, we could see their FY25 EPS rising by about 3%. As for the guidance wise, they have guided for higher net interest income of 94 billion. So this increase is really driven. It's sort of a slight increase, and they expect that it will decline maybe slightly in the first quarter and the second quarter of 2025, but it will pick back up in the second half of the year. So mainly from growth in their loans. As for the expenses, they are looking at around 95 billion, and this is driven by both the volume as well as revenue growth. So as revenue grows and their loans volumes grow, then expenses will also expected to grow. And last but not least, for the banking deregulations, we do expect that under a Trump administration, US banks, particularly the large banks with assets more than 100 billion US dollars, as well as the GSIBs, or known as global systemically important banks, are poised to benefit from banking deregulations. So for JPM, which is the largest US bank, we expect the deregulations will benefit their fee income as the barriers to M&As get removed and capital markets activity increase, as well as market presence from lower capital requirements, allowing them to expand more freely and aggressively. And last but not least, fewer regulatory requirements will also lower their compliance expenses and overall expenses. We do maintain and accumulate with a higher target price of $275 as we raise our estimates, our FY25 earnings by 14%. So we like JPM for its ability to continue growing revenue in all its segments, particularly in the consumer and community banking and corporate investment bank. So despite headwinds to their net interest income from rate cuts and potentially higher provisions from their credit card segment, their strong growth in management fees as well as continued net inflows will support the earnings momentum. Now moving on to the next the next counter we have is Bank of America. So Bank of America, we believe that they are firing on all cylinders, which is the title of our report. All of their revenue line items have actually gone up. So their FY24 PATMI was at 97% of our forecast, and it came slightly below our estimates from lower than expected market making and other income. So overall, they did record higher net interest income, trading revenue, asset management and investment banking fees, and their provisions also rose, which is, I guess, is not a good thing. So the DPS was up 8% year on year to 26 cents, and their fourth quarter common stock net repurchases was also up to 3.5 billion from 0.8 billion the prior year. Now for the positives, the net interest income was up 3%. It is I think one of the only four largest banks, they were the only one that saw an increase in net interest income, and this is really from their fixed rate asset repricing and loans growth of 3%. So they were able to put back in their excess deposits into higher interest earning assets, which is what allowed them to have this increase in their net interest income. I'll go into more detail later. As for the other positives, their fees have also surged from higher market levels, so it benefited both all of their fees, their asset management fees, as well as their global markets revenue, which covers their FICC as well as equities revenue. For investment banking fees, it has continued to rise, mainly led by the mergers and acquisitions, with strength seen across the capital market fees. As for negatives, they only have really one sort of negative for this quarter, which is that their provisions have also increased. And this is really mainly due from the consumers' loans, particularly the credit card segment, which has seen an increase. But nonetheless, if you look at it quarter on quarter, it has dipped by 6%. The provisions have dipped by 6% as the net charge-offs fell from lower commercial, industrial, as well as commercial real estate losses. As for the outlook For FY25, Bank of America is guiding for net interest income to grow around 6 to 7% in FY25, and they're expecting it to start off with a bit of a slower growth in the first quarter, 14.5 to 14.6 billion, but for it to expand to 15.5 to 15.7 billion in the fourth quarter. So they are seeing that second half growth will be larger than the first half. And the main growth drivers will come from the continued fixed rate asset repricing, as well as some loan and deposit growth. So the fixed rate asset repricing is really from the steepening yield curve, where the long-term assets are now finally able to get a higher interest rate as compared to the short term. So they're able to put it back into longer tenure assets, and then get a higher interest, and that's how they're able to roll it over, which allows them to sort of expand their net interest margins and net interest income. As for the expenses growth, it's expected to be slightly slower, with only a guided increase of 2 to 3% for FY25. As for loans growth, they are looking to expand their loans. They are continuing to expand their loans portfolio. They managed to get a 3% year-on-year increase, and they don't really provide any exact figures for FY25, but they've seen more optimism, activity, as well as demand from clients for loan growth. So with more growth again expected in the second half of the year, we are expecting around FY25 loans growth of 4%, with the drivers coming from credit cards as well as domestic commercial loans. And last but not least, for the banking deregulations, again, with what I mentioned for JPMorgan, but for Bank of America, they don't really have any direct benefits from the deregulations, but we do expect some broad-based benefits, such as lower capital requirements for lending, allowing Bank of America to increase their loan portfolio, higher fees from the general relaxation of regulations, and as well as lower expenses from the compliance requirements decline. We do maintain and accumulate with a higher target price of $50, and we do expect the FY25 growth drivers will be from higher net interest income from the fixed asset repricing, as well as the loans growth recovery, a continued growth in the investment banking and wealth management fees due to higher capital markets activity, and last but not least, a slower pace of expense growth. So that's for Bank of America. Let me now move on to the last bank which we cover, which will be Wells Fargo. Yep, next slide. So Wells Fargo, their fourth quarter earnings were of 5.1 billion were within our estimates, and with the FY24 earnings coming in at 101% of our forecast. So some few key highlights is that Wells Fargo recorded lower net interest income, but their higher investment advisory and investment banking fees, as well as lower expenses, boosted their earnings. For their DPS or dividends per share, it rose by 14% to 40 cents, and their fourth quarter common stock net repurchases rose by 67% to 4 billion. For the positives, the non-interest income has continued to support their earnings. So the total non-interest income growth of 11% came mainly from, was quite broad-based. It came from all over their non-interest fee income. So their investment advisory and brokerage fees, investment banking fees, card fees, deposit and lending fees all rose, which provided this 11% boost to their non-interest income. Expenses was also a big factor, in why they did quite well, which is mainly coming from the absence of the FDIC special assessment. And the last positive would be that their provisions and net charge-offs have improved, mainly due to a broad-based improvement across segments, and their total net charge-off ratio has also maintained stable year-on-year at 0.53%. Now moving on to the negative, they have one negative, which is that their net interest income has continued to decline. It fell the largest, I think, by 7% year-on-year, mainly due to the deposit mix as well as pricing changes and the impact of lower rates on floating rate assets and lower loan balances. So all these factors accumulated to them having a 7% decline. Their loans, the average loans, didn't grow. It fell by 3% year-on-year, and this is mainly from declines in their commercial real estate as well as residential mortgage loans. As for the outlook, we expect that Wells Fargo, they're guiding for net interest income to improve in FY25 by around 1 to 3%, and this is really coming from loans growth in the commodity and investment banking markets, banking as well as auto and credit card, as well as reduced higher cost market funding from deposits growth. And they're also reinvesting their securities runoff into higher yielding assets. So similarly to what I mentioned about Bank of America, where they are rolling over into longer tenure, higher interest earning assets. As for their expenses, it's expected to be lower at 54.2 compared to 54.6 billion in FY24, mainly from lower severance expenses and efficiency initiatives. As for the share buybacks, in FY24, they have 20 billion, which was up 64% year on year. And this resulted in their common shares outstanding lowering by 9% and their dividend per share improving by 15% year on year. Again, like JPMorgan, similar story, they did not provide any guidance on share buybacks for FY25, but they said that they will continue to return capital back to shareholders, like what they've previously done. So if we look at their stock repurchase programs of maintaining at these current levels, we could see their FY25 EPS rising by 9%. And last but not least, for the banking deregulations, I think Wells Fargo will benefit the most because they do have this 1.95 trillion asset cap which was imposed on them in 2018. So with deregulations, they will probably lobby for this to be removed, and this will allow them to expand their deposits and trading business. If this cap is removed, they're not as constrained as they were before. And also, mergers and acquisitions can also continue to grow from the relaxation of merger guidelines, and their profit margins will also improve from the lowered regulatory compliance costs. We do maintain accumulate with a higher target price of $85. We believe that Wells Fargo is set for another good year, with net interest income expected to turn around in FY25, as well as lower expenses from their lowered severance expenses and efficiency initiatives. And other tailwinds, we believe, will come from the continued growth in their non-interest income, particularly the continued recovery in their investment banking fees and higher gains from trading activities and stable provisions. So that's all I have for the US banks. I'll now hand it over to Miao. Thanks.
Thanks, Glenn. So aviation sector delivered a mixed performance in December 24 amid an uncertain outlook for the year. And SIA's share price saw a slight rebound after the release of better than expected December 24 data. And SES closed the month in the negative territory as the market adopts a more cautious view of the impact of US tariff. And we'll CAO ended the month flat. Next slide, please. SIS group capacity increased by 7.1% year-on-year and exceeding pre-COVID level by around 4.6%. And this resulted in a total passenger carriage for 2024 reaching 39 million, which is a 12.7% increase year-on-year from 2023. So 2023 was 34.6 million. Yeah, next slide, please. And its load factor also achieved a record high for the year at 88.5%. However, year-on-year wise, it continued its downward trend and dipped by around 0.9 percentage point year-on-year. This is mainly due to the high base in December 2023. Improvements are coming from the West Asia and also Africa regions, where the load factor increased by around 2.3 percentage point. And the rest of the world saw the biggest decline for Scoot, which decreased by 7.1 percentage point. The next slide, please. And cargo continues to demonstrate its resiliency. Volume growth exceeded capacity growth by around 2.2% year-on-year in December 24. And volume also surged by 13.5% year-on-year, driven by a combination of the low base effect in December 23 and also Christmas shopping seasonality and tight sea freight capacity stemming from the prolonged Red Sea conflicts. But the overall effect on SIA's top line is still marginal since it only accounts for a fraction of the SIA's total revenue. And next slide, please. Yeah, so for outlook, we believe the post-pandemic travel boom has already settled in a more stable phase as airlines wrapping up their capacity beyond pre-COVID levels. And the Asia Pacific regions is set to take the center of the stage, with Avalon, an aircraft leasing company, predicting that it will contribute to over half of the global seat capacity growth in 2025. And for SIA and other regional airlines, capacity is expected to continue to increase in first quarter 25, including the delivery of SIA's A350, which is scheduled to be delivered by the end of March 2025. And on the cargo side, IATA estimated that the global cargo volume will hit 72.5 million ton in 2025, which is a 5.8% year-on-year increase compared to 2024 level. And this growth is likely to be fueled by the strong e-commerce trend in Europe and also North America, and also the ongoing Red Sea tensions, which is pushing the hybrid cargo arrangement. Yeah, however, potential impact of an across-the-board tariff on cargo volume remains uncertain. And well, the possibility of such a tariff is probably isn't off the table, and it's not part of our base case scenario, as the broader economic and also market disruption could trigger is likely to spill back to the U.S. market. Yeah, so China's economy exceeded expectation in fourth quarter 2024, and GDP grew by 5.4% year-on-year, driven by the stimulative measures. And looking ahead to 2025, we do see like a more upside for both outbound and also inbound tourism, supported by the pro-consumption policies, such as the Shanghai Consumption Voucher, and also several initiatives to boost the culture and tourism industry, as highlighted during the Central Economic Walk Conference last year. Yeah, that's all for me. I'll hand over to Darren for first REIT. Thank you.
Yeah, thanks, Mel. I'll run through First REIT's announcement last week. So last week, First REIT, they received a preliminary non-binding letter of intent from Siloam. So the intent is to acquire all of First REIT's Indonesian hospitals, which accounts for about 72% of AUM, and 14 Indonesian hospitals. So this includes some of the mixed-use hospitals. Yeah, so previously, if you recall, First REIT, they had the intention to divest or sell some of these Indonesian hospitals as part of their First REIT 2.0 strategy to increase their AUM in developed markets to more than 50% by 2027. But this announcement actually came as a surprise, as now First REIT, Siloam is intending to buy all of the portfolio instead of just some of the hospitals. Yeah, so this is positive for us. So first of all, this just shows that, or rather, it supports the inherent value in underpinning the Indonesian hospitals. And the proceeds of this sale could also provide First REIT with more financial capacity for future acquisitions. So this is mainly in Australia and Japan. So, and the last one is that the sale could unlock value, especially since we expect that the sale will be done at above valuation to gain shareholder approval, because right now First REIT's hospitals are on a base 4.5% rental escalation. So every year it's highly likely that they will experience some portfolio gains. So as a result, it's only fair that the sale will be done at above valuation to gain the shareholder approval. Yeah, so what will happen now is basically First REIT is undergoing a strategic review to evaluate all options. And the goal is definitely to keep unit holders' interest in mind. So right now we maintain our buy call, no change our TP and estimates, because this is still a non-binding letter of intent and nothing is confirmed, and there's no certainty that this transaction will go through. So right now, First REIT is paying a forward yield of 8.9% and 2025 forward yield of 9.5%, which we still deem attractive. Yep. Next slide, please. So I'll just run through the REIT monthly. So we're expecting a better year ahead for REITs this year. Last year we saw the S-REITs index, it was down 11.8%. So that is just a share price performance. It doesn't account for any dividends. Yeah, so if you include dividends, the return is about 6% negative. Yeah, so last year the worst performer was the US office, continues to be very weak, but we are starting to see some signs of recovery, especially in some of the stronger markets where we saw like Manulife, for instance, there's a little bit of a portfolio gain in some stronger, like the Atlanta office and such. But the weaker market still remains very weak, with very weak leasing demand and rental still very flat. So the recovery in the US office is very very really depends on the sub-market. Yeah, and other than that, the rest of the REIT subsectors, most of it rather all of it was still down last year. But going forward, we expect the REIT share price to increase. Yeah, I'll explain more in the next few slides. Previous in the previous slide there was we saw hospitality is up 5.3%. That's mainly because of Phillip's hospitality. We suspect that there's some interest in the takeover again. Like previously they had a general offer, so we think that something like that might happen. So moving on to our 10-year dividend yield spread. So basically, this just means the forward dividend yield minus the 10-year Singapore government savings bond yield. We see it increasing over the past few years, and we expect this to continue increasing for two reasons. So one reason is that we expect DPU, the absolute number of dividends, to start increasing this year by 2% and increase further in 2026. So the dividend yield will likely to increase, assuming the share price remain constant. And next is the 10-year Singapore government savings bond yield. We expect that to continue, or rather to decrease going forward with interest rates coming down. So as a result, both ways it will expand, and the 10-year dividend yield spread will likely increase further. So we're expecting it to hit the 10-year average soon. So going forward, this will look attractive. And looking at just the 10-year yield and the SORA, the 10-year yield month on month it grew 15 basis points. It's rather volatile now, and the 3-month SORA it continues to fall. Next slide, please. So next is the forward dividend yield spread. So right now it's at 6.4%. It's at above historical averages, mainly because of the share price performance in 2024. It was down 11%, like I showed in the first slide, so it's pretty weak. But we expect a share price recovery, especially since DPU is expected to increase this year, as well as the fact that the price to NAV is at 0.86 times, and that is even lower than COVID-19 lows. And we think a lot of the negatives are already priced in, like the interest rate trajectory and such. So we expect share price of REITs to improve this year, and we think it's a good time to enter. Next slide, please. So for subsectors that we favor, we still favor retail the most, mainly because of a few factors. So one of it is the improving international visitor arrivals. We expect that to hit pre-COVID levels by this year. So that is one. Next is the fact that Singapore government has in 2025 are going to have various payouts or handouts to Singapore citizens and PRs. So that's also going to boost tenant sales, and as well as the population growth. So we're expecting in 2024 there was some very strong positive rental reversions for retail. Like a downtown mall saw high double digit, or rather high teens to low 20s positive rent reversion, while suburban malls saw high single digit rental reversions. So we think this trend will likely continue for the next few quarters at least. We noted that the tenants they believe the outlook for tenant sales is strong, so that's why they're willing to pay higher rents. Work from office also, that the trend like getting employees to return to office also will help with the tenant sales, like for F&B especially. And for fourth quarter 2024, rents rose by 0.7% quarter on quarter. So the full year island-wide rents for retail, it rose by 3.6%. So things that are also supporting the positive rent reversions are the low occupancy costs. So right now it's still below historical averages for the occupancy costs, and as well as the limited supply, incoming new supply for retail. So these are the factors why we still favor retail the most. Next slide, please. So for hospitality, we still track these numbers. So in November, visitor arrivals, it grew by 12%, and the RevPAR for November is the growth was also quite strong at 5.7%. The growth definitely will have slowed from the 2023's level, because 2023 grew by like triple digit, because from the high base from low base in 2022. So going forward, we expect it to normalize to pre-pandemic levels of about low single digit to about mid single digit hotel RevPAR growth, yearly growth going forward. And in November 2024, there were some positive signs, especially from the improvement in hotel occupancy. It was up 2.5 percentage points in November 2024. And hotel average daily room rates, it seems to have moderated, but it's still slightly growing at a slow pace at 1% in November. Yeah, and just to note that the hotel RevPAR and international visitor arrivals, hotel RevPAR is up 13% from pre-COVID levels. Rather hotel and international visitor arrivals is still down 19%. So this year, like I mentioned, we are expecting that to hit pre-COVID levels. So some of the things that are supporting this are like the World Aquatics Championship. So that will happen this July, as well as a competition of Minion World and the rebranded Singapore Oceanarium. So these will help to support demand for this year. But just note that first quarter numbers are likely to be weak because on a year-on-year perspective. Because first quarter last year we saw Taylor Swift and Coldplay, and this year we don't see any major concerts. So as a result, this first quarter we're likely to see some decline, but the next few quarters we expect it to return back to growth year on year. Yeah, so next slide, please. So next we have our just our coverage, table of our coverage. Yeah, so not much changes there from the previous month and from our SSBs. Yep, so that's all from your hand over to Zane for the technicals. Thanks.
Thanks, Darren. Good morning, everyone. I'll talk about the technicals. Next slide, please. Yeah. So looking at S&P 500 last week's the price action, we had a recovery when price actually opened at a price gap during the election after the election at 5,780. Subsequently, we saw a recovery above the 5,830 key support level, and end of the week with a breakout above the descending triangle resistance, which is highlighted in blue. So I think overall last week the whole week itself was up about 2.9%, which was the strongest weekly performance since the election week. I think we are likely to see some further upside with this current momentum. With immediate resistance at 6,020 to 6,100 area, support at 5,130 to 5,980 area. Next slide. Next one, we have a technical sell stop for Grand Venture Tech at 81.5 cents. Take profit levels at 77 cents and 72.5 cents. Stop loss at 84 cents. Last close was 84 cents on Friday. So for this trade, it hit our stop loss. So the initial trade idea was that price form a double top at the 88 cents level. There was also a crossover of the 5-day simple moving average under the 10-day simple moving average, which could denote a decreasing bullish momentum, coupled with fresh bearish crossover on the MACD and bearish divergence on the RSI. Yeah. Next slide. Next one is a technical sell for Olam at $1.14. Take profit levels at $1.06 and $1. Stop loss at $1.17. Last close was $1.14 on Friday. So for Olam, next will be a head and shoulders formation with the neckline at $1.14. Also, bearish price action was actually seen from the start of December, where price broke above the $1.25 resistance level, but however was unable to hold above it, and it subsequently became a resistance in start of this year when it did a retest. So with that, I think that should it break down this neckline support, you could see further decline in momentum towards these two take profit levels with the decreasing momentum on the MACD, going under the zero line as well. Next slide. So this is just a summary of the two trades initiated. For Grand Venture Tech, here stop loss, so it's down about 3.1%. For Olam, it's currently flat. So I'll hand over time to Paul to talk about the Singapore weekly now. Thanks.
Yeah, thanks, Zane. I'll move on to just our usual macro. Is this the slide? Yeah. Yeah, okay. I'll just move on to some of the key macro highlights for 2020 for last week. Sorry. The main numbers was the home sales. So new home sales was very strong. It's still up 50% year on year. I think the November was some spectacular, almost 3,000 units. And as a result of that, you get almost tripling or 200% jump in the fourth quarter sales. In terms of the impact to the real estate, the real estate agencies, you will see some of it in this year, but in 2024 results, but some of it is also on 2025. So in a way, that's a positive. I kind of smooth out the earnings for them, because usually when they do a sales, it probably take them at least around 1 quarter later to recognize the revenue. Singapore exports was strong, still holding, especially electronics. We did speak to some logistic companies. They did mention there was a heavy deliveries in December too, because of after the Trump's victory. So we're not sure how much of this again is due to some inventory loading in the US. Taxi numbers continue to be weak. There was a modest rebound, but the taxi fleet continues to fall around 3 to 4% a year. For US retail sales, this is just for us to gauge the health of the US consumer. It remains healthy. I mean, maybe 3 to 4%. So it's still growing at a steady pace, similar to pre-pandemic. No red flags here on the US economy. Likewise, for unemployment claims, again, also still stable, no red flags. So generally, the US economy is still growing and steadily. Next slide. Move on to our usual tactical views. So, I mean, the main thing is the shock and awe that you should expect for Trump's inauguration. It will probably be tomorrow morning. We will get it, I guess, the shock and awe. But to just get a sense of how the tariffs will be implemented, there's this person called here Stephen Miran. Most of us won't know. I also didn't really know him, but didn't know the name. But he's going to be the chairman of the Council of Economic Advisors. So technically, he's going to be Donald Trump's economic advisor. So he did write a paper in November, if you Google it. So he wrote a paper to give a roadmap of if he were to implement tariffs, this is how it would be. So their view on tariffs is that there will be no impact on inflation. So what happened was that when in 2018, 2019, when Trump imposed tariffs on China, the effective tariff on China was around 17%. But on the flip side, the renminbi, the exporting currency, depreciated 15%. So there was really no impact on inflation in US dollar terms, or very minimal. So in a way, the tariff burden is actually on the Chinese consumer, because their currency actually weakened so much. Again, this is their view, and this is why they can justify tariffs. So if this happens, there won't be such a worry on the US that inflation will run out of control, so long as the exporting currency depreciates. So that's the first point. The second point that the paper made was that there'll be a gradual rise in tariffs. So don't expect Trump to impose, I'm assuming, let's say 60% or 20 or 30% tariffs. He will not impose it immediately. That means tomorrow they'll be imposed. So what the roadmap he's saying is, the playbook here is that it will be gradual. It will be maybe 1 or 2% a month. Why you want to do this is to avoid volatility, because imagine if Trump were to impose tariffs 60% tomorrow, then the whole currency market, interest rate market, everything will turn volatile because of the uncertainty, and of course the uncertainty over global growth. So to do it, he will probably phase out the tariffs. I mean, nobody knows, but this is his playbook. They will phase out the tariffs and to avoid volatility on the financial markets, and also negotiating leverage. So to negotiate is, Trump would just say that if you don't either open up your markets or buy more things for me, every month I would just raise the tariffs maybe 1% or 2%. Again, I'm not sure, but this is the playbook. The last point on this paper, because he's going to be the advisor to Trump, is that he thinks that the US dollar is overvalued. We don't think so, and Trump never explicitly said that he wants to weaken the US dollar. So, but again, this is again the playbook. So if the US really wants to weaken the US dollar, these are the flags to watch. So they want to do a currency accord. So something similar to the Plaza Accord, which is in a nutshell just force other countries to sell the US dollar. Although they call it a accord, but it's more like forcing other countries to sell the US dollar. Another playbook is to restrict foreign purchase of US treasuries, and also maybe the US Fed will actually buy other currencies and stock up on FX reserves. This is what they will do. So if you see all these things, then you know that the US wants to weaken the US dollar. I hardly doubt it, but anyway, this is just to watch for all these things. But what will happen is that if all these things were to materialize, what you expect is that Asian currencies will weaken. So if the tariffs occur, all currencies should weaken except the US dollar. But the good thing is that then you won't get the high inflation in the US. This is just a scenario until tomorrow, see what he happened. Tomorrow morning, we really don't know what he's going to announce. But again, just to get everyone informed, I mean, this is just to get the understanding of it. We also had a lunch meeting with Singtel. There was no report about it. Share with you some highlights. So, as Jitman mentioned, there's this NVIDIA restriction. Semiconductors actually has been restricted. The GPUs has been restricted for sale in Singapore. You can buy a certain quantity, but every quarter only there's a quota every quarter. This is not affecting their GPU as a service. And generally, Singtel is very cautious on GPU as a service because they think there's technology risk, uncertain long-term demand, and clear pricing. But most of the countries is still performing well. I think Australia is still doing rationalization, another word for cost cutting. But it sounds nicer. Prices are rising, so the mobile prices are rising. India is important, so India is a source of liquidity. They're going to get more dividends from Bharti, and then they're going to equalize the stake. So just to dial back a bit, so Singtel and their partner Bharti Enterprise, so Singtel has a stake higher than Bharti Enterprise, so they want to equalize. That means each one have an equal share. So as a result, there could be maybe 8 to 9 billion worth of sales for Singtel. There's some spectrum bidding in Thailand, but since it's a duopoly, it should be okay. Indonesia is the model competition is intense because Singtel prices there are very high. So that is starting to stabilize. But again, what they can do is maybe bundle mobile with broadband. So in terms of Singapore, of course, everyone's interested in Singapore. So Singapore, of course, if there is a consolidation between StarHub and M1, nobody knows. What to watch out for is they want rational competition. So based on their experience in working in so many countries like India, so long as the incumbent or the merged entity do not say that they want to be number one, then there usually won't be much of a irrational price competition. But if one of the operators say he wants to the biggest, the largest, then the competition will be very intense. So this is another red flag. I mean to watch. Yeah, I mean today all red flag. Okay, anyway, the key things to watch today is the Trump inauguration, Netflix results, and again, all this is just for your reference. We do have some webinars. We have OUE REIT on Friday. It's open to anyone, and we have all these REITs. Only Keppel DC is in the morning. The rest are usually 12 p.m. So feel free to dial in if you have the time. Next slide. Next few slides is just graphs, just charts. So anyway, you can see here, this is the new home sales in Singapore. It really collapsed, but the last 1 month, you can see the big spike. On average, we sell about 12,000 units, but realistically, I think it should be about 6,000. So at 4,000 was unusually low. So for the whole year, new home sales were generally flat. The one on the right here is just the quarterly numbers. So you can use this as a way to gauge how the real estate agents kind of revenue too. Next slide. Again, I think this is just the exports very volatile, but generally it's stable. There's no collapse. And then that's a taxi fleet in Singapore. Next slide. Then this is just the US. We just monitor if there's any sudden collapse. At least we'll. I don't think we'll be the first to know, but at least we can actually monitor the blue line on the left. So this retail sales, the consumer spending in the US, is just moving sideways 3-4%. No, there's no real major collapse like you get during a recession or in the red line electronic appliances. The one on the right is just the unemployment claims, the initial number. So again, it's stable. So there's no real major red flags from the US. Next slide. Then this is just the latest expectations on interest rates. So how you read this is the shaded part is where the market is forecasting. So the numbers you see here, so the US maybe a month ago they were looking at 80 basis points cut, now it's 40. So you can say that the US in 2025 expectations are from 3 rate cuts now to 2. EU is the most. So EU, you're looking at 4 rate cuts. So that's why we are still bullish on Stonewich. Yeah, the Cromwell of it. And only Japan will be raising rates. So something to watch on Friday if you are macro. And Australia is important too because a lot of the operators, a lot of the REITs own assets in Australia. and also in the UK, especially elite. So that's why we watch this closely, because no, this has big impact on all the REITs, like Darren mentioned. With that, I think we can move on to Q&A. Thank you.
Thanks, Paul. Yeah, maybe let me take on some of the Q&A. I have quite a bit for the banks. I think one for Tesla. So, what's the impact of any of Basel III on JPM and the US banks? Yeah, so I think it's the Basel III endgame. So, a good question. What is the impact, and why the banks are so against it, right? It's because they are looking at the Basel III endgame and at least the current rules, is that it will increase their capital requirements. So that's the biggest sort of impact to the banks. If that happens, it means that firstly they are unable to expand as fast as they can, because now they have to hold more capital than they previously did. This is really stemming from the multiple factors, but one of the factors I think that really pushed it over the line was what happened with Silicon Valley Bank, and that whole the banking sort of downturn or fiasco that happened a few years ago. So that was what really pushed it over the line. So in actual fact, now if this goes through, it's still of course under talks. If this goes through, it means that the banks have to have more capital than they set aside more capital, than they currently have. So than they currently do. So this will mean that they will impact their expansion. They may not be able to do as many acquisitions or mergers as they would like. All right, they are unable to enter markets, as freely as they were. And also the other factor is that they may not be able to do as many share buybacks or to increase dividend as freely, because now their capital is more constrained. They have lesser excess capital. But then again, this leads very well into the second question, into another question, which is asking, what would Trump's administration do, and how would the deregulations impact the banks, which I did speak briefly about for all three banks. But how would this impact them is that they are looking at their lobbying efforts, which they have been doing quite a lot. The banks, it's very different in Singapore and US, because in US they are able to lobby against the regulations that the Feds put up. Right, so here in Singapore, it's slightly different story. You just listen to what MAS says, but there they can lobby against it. And if they lobby against it, they can hire the best lawyers and whatever to lobby against it. So they are trying to lobby to lower the capital requirements. And under Trump, that will be one of the biggest thing where they can effectively stall the Basel III endgame, or make it easier or lesser for the US banks, especially the large ones. The large ones are the ones that will have the most impact because they have the highest number of assets. And I think it will impact them the most as compared to maybe the smaller regional banks. Yeah. So that's the impact for the Basel III endgame. And also a bit, on the other question of how would sorry, let me read the other question out first. What are some of the possible deregulation measures for US banks under Trump? Yeah, so that's one of the possible deregulation measures where, it might not go through, or their lobbying efforts pay off, and then the requirements are lowered. So it's not as it doesn't impact them as much. And of course, like what I said earlier, there are also other kind of deregulation measures such as lowered compliance requirements, which will lower their expenses, and also relaxation of merger guidelines. And I think specifically for Wells Fargo, where they are trying to remove that 1.95 trillion asset cap imposed in 2018. So they are trying to get that removed. So maybe under Trump it will be successful, and then they are able to grow further. Okay, let me go through the other questions. Will expectation of less number of interest rate cuts for 2025 benefit the US banks? Yes, definitely. So if that happens, it will impact their largest revenue segment, which is net interest income, and also their net yields, or in other words, their net interest margins, because they are able to get basically earn more from loans, from their loan and asset yield, but they are while still being able to reduce their cost of funds. So their cost of funds their deposit cost has actually risen quite tremendously. But because of expectations of more rate cuts, their loan yields have also declined. But now that there are lesser sort of number of expected rate cuts, they can maybe slowly increase their loan yields up a bit more while keeping their deposit and cost of funds down. So this will increase that spread that they have. And I think more importantly, it's also the yield curve that will benefit the US banks quite a bit. As long as with the Singapore banks as well, all banks in general will benefit from this, being that the long-term yield is now higher, it has gone up above the short-term yield. So what the banks do is that they take excess deposits or deposits that they have, which they pay, minimal amounts. They pay the short term, the 1 year, and then they put it in the 10-year. So previously, what happened was that the 10-year was below the 1 year. So it's really not like it's an inverted yield curve. So it's not worth it for the banks to do that because they aren't able to earn that spread. But now that it's steepening and it's becoming normalized, we could see this spread come in, which is why I think Bank of America has benefited the most for the fourth quarter results. But going into FY25, I believe that all the US banks, and especially the large ones, will be able to benefit from this steepening yield curve. Let me find the other questions. Of all the US banks, which one do you think is the best valuation to add new position? I would say if you look at at least the ones that we cover, right, the three of them, if you think longer term, JPMorgan does have their hands in every segment, right? And it's like quite a equal amount. If you look at Wells Fargo, it's really more retail kind of banking. If you look at Bank of America, they're looking at wealth management, asset management kind of style. But for JPMorgan, it's a bit of everything. So they do asset wealth management, retail banking. They also do investment banking. So if you ask me, looking ahead, I think JPMorgan stands to benefit the most if from this environment where the lower than expected interest rate cuts, and then Trump coming in as well will lower the deregulations. And them being the largest, we can only help them in pushing for new sort of deregulations, and they are able to expand even further. Because what was previously happening is that the Feds were really very against the largest ones because they're scared they get a monopoly, right? And that they are essentially they think that they are too big to fail. But with JPM now coming in as the biggest and helping to sort of lower the regulated and some deregulations expected to come in, I think they'll benefit the most. I think there's some will I be covering cities widely held in Asia? I thought you guys are planning to cover in 2024. Yeah, if we do, then just watch out for if there is anything, just watch out for the report. We will definitely send it out if we do start coverage. Yeah, if we do. Yeah. But we'll take a look. We'll take a look at it. Thanks for the suggestion. Okay, there's one on Tesla. Will Trump roll back the $7,500 EV tax credit? How will it impact Tesla? Yeah, this is a very good question. There are a lot of sort of ideas and takes on this. So basically, Trump has indicated that there's this $7,500 EV tax credit, right? And Trump has indicated plans to roll back this thing and just basically remove the tax credit. It's similar to the one in Singapore. The government is giving the EV credits as well, where you buy an EV car and then you get some tax credits. So we believe that in the short term, definitely their profit margins will take a hit, mainly due to the loss of this tax credit. But if you really listen to, if you believe what Elon Musk is saying, he's saying that yeah, it will hurt them slightly, but long term it won't affect them because it will only it will really heavily affect the competitors, right? Their competitors, Tesla's competitors, who rely more heavily on the credit. He's basically banking on the fact that Tesla is the largest in the US, so right, it won't affect them because if you want to buy an EV, most people just think, okay, we just go with Tesla. So that's that's what he's trying to say. But if you look at it, there are a lot of other factors, not just this tax credit. The fact that the supply has increased drastically, right? They're able to produce more cars, and now the second-hand market is also full with Teslas. So if they don't have this, tax credit, they might go away from buying maybe a new Tesla, but they'll just jump into the second market, which is flush with Teslas. What was happening maybe quite a number of years ago when they first started, and there was such a hype over the Tesla cars, was that the demand was very high, but the supply was even lower, was low. So this drove the demand up for Tesla cars. But now that the supply has caught up, right, and the demand has sort of reached a nice equilibrium, right, this tax credit will probably only actually hurt them more than it will benefit them, by removing competitors. Because the competitors are also, just to put in that the competitors, a lot of the competitors, if you talk about the main competitors like, Rivian, or no, BYD, I would say BYD maybe is the main competitor. Rivian is really too obscure. So the BYD, their main market is also in China, right? The China competitors are coming in. But then again, if tariffs do come in, then that will also affect their competitors. So it's really a whole multitude of different factors that will affect Tesla, not just this, just by this removal of the 7,500. But I think it will be more detrimental than beneficial, at least in the short term for Tesla. Let me find the question. Okay, let me look through and see if there's any other questions for me. Will UOB be outperforming this coming quarter results? We believe that UOB, not just UOB, but I think all three of the Singapore banks will outperform as what they've done, at least for the last few quarters, mainly coming from, again, like what I mentioned, where I said that the inverted yield, the yield curve has sort of gone back to normal. So the Singapore banks also benefit greatly from this because they do hold a lot of excess deposits as compared to their US counterparts. And then they're able to put that back in, and then we can see that their net interest income, net interest margins actually are stable, even though rate cuts have kicked in the second half of 2024. So that's the one of the line items. The other line item that will do well would be their fee income. So fee income with their wealth management has been doing particularly well, and we believe in an environment where low risk or no risk or low risk sort of deposits are really almost non-existent, or it's really too low of a yield. Even the T-bills and SSBs are extremely low, right? They are turning now to the banks to say, okay, why don't you manage my money instead, because you can garner a much higher interest. So that is what is benefiting their fee income and wealth management income. So we believe these two are the main line items for the local banks that will continue to do well in the upcoming quarter's results, which is fourth quarter 2024 results. And also not just that, but going forward into this year in FY25, this will continue into FY25. But particularly for UOB, I think just the main differentiator that they have from the other banks is that they had a very big spike up in their CET1 ratio, their Common Equity Tier 1, mainly due to the Basel IV, where they moved over to Basel IV. So UOB, the reason why they had this huge jump up is because they were mainly SME bank, so a lot of their loans were very well collateralized, and a lot of it was secured compared to the other banks. Maybe they take on a bit more unsecured sort of collateral, so they were able to gain a much bigger jump up in their Common Equity Tier 1. And what this means is that they have a lot more, now they have a bit more excess capital. And for the first time in a long while, they did hint at giving back, aggressively managing their capital. So it points at two things: it's either share buybacks or higher dividends, right? Hopefully they will announce. They did say they will announce something in the fourth quarter results. So when it comes out, then I will cover that as well. Let me see. I think there's one in the chat. Do you foresee major bank mortgage defaults from the California fires in 2025? I don't think that will happen. Mortgage defaults, it might hurt some regional banks, sorry. But if you look at the big banks, no, I don't think it will make much of a difference. Firstly, it's not the first time they have gone through this. And also, they do have insurance to cover, like this kind of California, like fires in if it does happen. So it's not like it's not I would say like it's not a COVID per se, where it was really out of the norm. Yep, I think we see some questions here in the chat. Please put it in the Q&A so that we can easier for us to look through and to answer it once it comes out. I think that is all for me. Yeah, there's one about the SGX coverage. Yeah, we do still cover, but because they only give out a half-yearly report, so we a result announcement, sorry, so we do follow that. Okay, maybe I'll hand it over to the rest of my colleagues. Thanks.
Thank you, Glenn. I guess I'll take on the Netflix result. So we do expect pretty strong set of result coming from Netflix. Everything's been doing pretty smoothly for them. Their membership continues to grow. Their price is increasing, so that means better monetization for them. Their margins have been trending well, pretty well in the last few quarters. We think the company right now is still in a pretty sweet leadership position, because if you look at their main competitor, they don't really have a direct competitor. Their main competitor is Disney, and they have 35% more membership compared to Disney, and they monetize pretty much 2 times better. They recently tried to grow their ad department, which has been a major success. It kind of lowered down the pressure for them to add on as many new subscribers as they used to. Right now, it's still a very small fraction, but they expected it to grow almost 2 times in FY25. So everything overall is pretty positive. But we do think the reason we actually have neutral rating on the stock is because we feel like the valuation is already quite full. It's at 28 times the PE ratio, which is a significant premium over the industry, which is only 17x. So yeah, overall, we do expect pretty strong results from Netflix. I hope that answers your question. That's all from me, I think. I'll pass my time to other colleagues.
Okay, there's a question on the impact of CDL's news this morning. So CDL's news is that they have an announcement with the notice of intention to make a full takeover offer for the Millennium and Copthorne hotels in New Zealand. So currently, CDL they own 76%. So with this news, they want to acquire or rather they want to acquire the remaining shares, and they want to delist this Millennium and Copthorne hotels New Zealand Limited. Yeah. So right now, the news is rather positive because first of all, the MCK shares, the sorry, excuse me, the Millennium and Copthorne shares that's trading in New Zealand right now, the trading volume is historically very low. So that is it's very illiquid as well. So that is one reason why I think they also want to just privatize it. Another one is they also want to save on the listing fees and other costs that associated with the listing, because anyway the shares are not really there's not much volume there. So yeah, so it's better off if they just privatize it, and they can just reinvest all these cost savings into the portfolio of assets and reinvest it and for operational needs or further expansion. Yeah, but basically this news, it won't have any material impact to FY24 or FY25 results as well. So it's not very material news. Yeah. What's the latest on Manulife REIT? More potential sale of properties expected this quarter. Yeah, so Manulife REIT right now, they have sold 110 million US dollars worth of a property, that was capital last year. So as part of their recapitalization plan, they need to divest 328 million by June 2025. Otherwise, it's considered a so-called default position, and you have to renegotiate everything with their banks again. So basically over the next 2 quarters, this quarter, next quarter, they need to divest at least another 210 million plus around 210 million more US dollars minimum before they'll so-called not reach that the target of 328 million. So definitely we do expect more sales of their properties in these next 2 quarters. Right now they've mentioned that during their analyst call during the year-end portfolio valuations that they had last week, they mentioned that they're in potential talks with about 2 to 3 different buyers for some of the properties, but definitely we don't expect those sales to be at a good price. Yeah, we still do expect those sales to be at a discount to valuation. They are highly unlikely they will be done at close to valuation as well. Yeah, so that's the latest. Yeah, the latest, other than that, last year, or rather last week, if you missed the news, is that their portfolio valuations was down about 9% for FY 2024. Yeah, so those are the latest. Yeah, and one more thing about Manulife is that because they missed their soft target, it was about 200 million by December 2024. So they missed that target. So as a result, they had to pay about 2.3 million in penalties to the lenders as well. There's a question on Suntec. I'll leave that to Meow Meow. How would Trump 2.0 impact REITs? We should be cautious to position ourselves. Yeah, so in my view, the main thing that affects REITs definitely still the trajectory of interest rate cuts. So our house view is still four interest rate cuts. Right now, the market is projecting only one or two cuts. So it all really depends on his policies. But definitely we are keeping a lookout as more interest rate cuts definitely will continue to will benefit the REITs. So they'll save on their interest costs, and also transactions will start to return. Like there's more inorganic growth potential as well from divestments and acquisitions as well. Yeah, so there are, and also with interest rates starting to come down, you also see portfolio valuations start to improve from cap rates starting to compress. But this will take some time. Yeah, we've seen Stonework really announced that their portfolio valuation for 6 months it grew slightly with from compressing cap rates in some of the markets. So we expect this to continue in the other markets as well. But yeah, the aforementioned the Australia is a market that we're looking at as they have not cut their rates yet, and yeah, so that is the issue. What's the negative impact on the local REITs with the looming SEZ, especially for retail and industrial subsector? Yeah, so for retail, likely there, I mean, currently a lot of people really going to JB for shopping, but so I don't really expect much change for retail per se, but definitely there will be a change. Like the SEZ might continue to attract more shoppers, like more Singaporeans there to shop. And I mean, even though now already a lot of Singaporeans already go there, it might attract more. But I think those who are already there who already been going to JB to shop, they are not like no new people will continue to go JB to shop rather. So those who shop right have already been going. So those who don't shop, they probably will not specifically go there just because of this SEZ. Yeah, that's what I'm trying to say. But this SEZ definitely will continue to will pose some competition to our local market as well, as it is possible that some of the tenants might want to relocate there, as they might see some better leasing terms and maybe cheaper rent. So that it is possible that local REITs might face some competition from that, but it's still hard to say now. It's still very early stages. Yeah, so that is for the retail sector. I don't think there'll be much impact to Singapore for the retail sector, like negative impact, because Singapore is still rather resilient. The fact that the supply is still low, tenants are still expecting some strong international visitor arrivals and population growth and return to office and such to help boost the retail numbers. So yeah, I don't think retail factor will be very affected by this new SEZ. For the industrial sector, maybe they'll be more affected as they might divert demand away from the Singaporean local warehouses and distribution centers that are owned by the local REITs. So that is one factor. And yeah, probably those logistics assets also that are not in the SEZ area might have some valuation like asset depreciation rather, as the zone as the demand for all this space shifts towards the SEZ. But this is still very early stages, so still really hard to quantify the impacts. But for us, these are our views for now. With property market strong in Singapore, will this be a catalyst for CityDev share price? Yeah, things are starting to improve for CityDev, especially now that we've seen some strong numbers in their sale. Like over the week, I believe the Ori, if I'm not wrong, I saw the news. They are 80% taken up. 86% taken up over the on weekend. Yeah, so that is good news for city developments. And but city developments, they still have one more project, Newport Residences. So they've really pushed that back, and we're not sure when they'll start to launch that. But that's mainly because the target customers for that is the higher end. The higher end market, like for foreigners, they're still impacted by the 60% ABSD. So basically all the foreigners have already vanished from the market. So things are starting to recover. And CDL right now, they're still trading at a steep discount to the NAV, RNAV, like over 50% to their base NAV as well. Yeah, so it might be yeah, but definitely China is still a drag for them as well. Yeah, but things are starting to recover for the property market. Yeah, I hand over time to my colleagues. I think that's all from me. Thanks.
Yeah, thanks, Darren. I'll just try and answer as many as we can before 12. Why China markets up today? I guess it's the phone call, the fentanyl, fentanyl, sorry, conversation that they had, that he seems to be warming up to China. And I guess this is what we are hoping for too, I guess, in terms of our three investment teams for 2025. Because so far he's been hostile to Canada, Denmark, Mexico, but he hasn't really been, his commentary hasn't been explicitly hostile to China, I think, yeah. But again, nobody knows. I mean, it's like I said, it's shock and awe, anything can happen. So just have to wait on his inauguration, what he's going to say. Hi Paul, what do executive orders do, and do they give Trump unchecked powers? Yeah, in terms of executive powers, mainly on the tariffs. So executive powers is mainly on unfair trade practices by a country, and also national security. One way to remember is UN. So it's like unfair trade practice and national security. So he can impose tariffs without going through the Congress. So that's why in 2018, 2019, you can see that he can impose tariffs pretty fast. Yeah, I mean, at least he can announce, and then he doesn't need to go through Congress. Yeah, so that's what we mean by executive powers. So anything on national security, anything can happen. I say, oh, too many migrant workers, national security problem. Okay, I slapped Mexico with tariffs. I think you can just make it up as you go. I know what is national security. Yeah. Thanks. In your view, what would Trump do with I'm not sure. Maybe you can. Maybe I'll leave that to Helena because she covers Shopee. What's your take? Hi, Paul. What's your take on Q&M MOU news? Yeah, I think it's very positive. I think, of course, the downside is that it is MOU and there are no numbers. But in terms of the blue sky, I mean, if you can, if there is such a thing, if there is such a deal with numbers and everything, 1,000 clinics, you can think of it. Q&M becomes not just a dental clinic, becomes a technology play, because he can maybe charge every person who uses the AI maybe $5 to $10 per usage. So for those who may not know, I actually used it myself when I was in JB, because it's cheaper, right? So what they do is that they would this AI will take a scan of your teeth and everything, your jaw, your gums, everything, and then from that they will tell you what are the issues. The pictures are nicer, it's colored and everything, and it will show you like what are the problems you have with your teeth. So it's like almost like an auto evaluation of your teeth and everything, and gums and everything. So the game plan here is that the issue you have is that when you try to sell it to Singapore clinics, then because Q&M is a competitor, they worry about the information and so forth. So the key is to sell it overseas, and with overseas, you can just charge any patient who opts for it. And the ideal scenario is that they will use it as a standard. That means every patient will want to have an X-ray of their teeth, but they will help the doctor kind of, and also they can show the patients that this not the doctor kind of analyzing, but the software or the AI can actually identify the problem areas with your teeth. Yeah, yeah. We'll try and give an update and try and do some report on this, but yeah, hopefully in the next few weeks. With higher yield for long-term 10-year bonds, will this be positive or negative for bank earnings? Okay, then I'll leave it to Glenn. Hi, Paul. Do you expect China to adopt the same depreciation strategy in Trump's first term to retaliate against the tariffs? Most probably, the renminbi is actually a control currency. So my guess is he will do this because there's not much growth in China. So if the export growth is also shut out from China, then there's really not much growth driver, because China still, as they transition their economy to, I guess that's the plan, to transition to more AI, there is no real growth driver because they're not really stimulating the domestic economy. So the China still relies a lot on US and on exports. So they have to depreciate. And of course, once China depreciates, it will affect all the currencies here, including Singapore. Because now Singapore has a basket of currencies we benchmark against our trade partners, and of course, China is a major trade partner. Then other countries will depreciate. I know you can just name it. Thailand, in Malaysia, everyone will depreciate once China goes down, because China is the biggest trading partner. Would Trump prefer a strong or US? Actually, not really. Some interviews he say he wants. Most interviews he actually says he wants a strong US dollar. Then sometimes he will kind of deviate a bit for him. So it's not really clear, but I would swing towards him. He has actually mentioned he wants a strong US dollar, actually. At least to be the reserve currency to the world. I think that's what he said. There's a lot of strategic value to that. So that he's mentioned that before. Have rate cut expectations changed after CPI? Yeah, I think it nudged down a little bit. But I think everyone is just worried of the Trump tariffs, the impact on inflation. I think that's the biggest worry. And of course, whether he will do more aggressive fiscal spending. So that's why the market has moved a bit, because the CPI was better than expected, or inflation was better than expected. Any change in ComfortDelGro's target price after the adjustment to his commission? Not really. I think for us, there are so many moving parts to that. There are also the UK, but we're not going to change because of that that move because again, the taxi business could be also competitive. So whatever commission you increase might also be offset by competition. So we really didn't move. And also, it's very hard as an analyst to move all these numbers because of the competition. And also, we don't have that much granularity. We don't have like taxi business or the line item, how much is commission, how much is the the staff cost, the impact of all that. So it's very hard to kind of model it correctly. And taxi is just one of their many other businesses. So that's why it's hard to give maybe a 1-2% impact, but yeah, so it may not be that material. How could US stop other government buying its sovereign debt when their fiscal deficit? Yeah, I think it's going to be difficult because if interest rates climb and then then who's going to buy? Yeah. The one still buying the US Treasury's sovereign debt is actually a lot of the European countries. Not so much China. China holdings actually coming down. I mean, next time I'll show the chart, but China's coming down. I think Japan and the UK, Europe is still buying the US sovereign debt. Yeah. I don't think it can happen because if interest rates keep climbing. Yeah. I'll leave this one to Darren, and there's a Meow Meow. Hi, Paul. Trump and Xi phone call discuss about fentanyl. What's important about it? Yeah. So, as you know, it's that drug that is used for it's not Ozempic. Sorry, it's the drug, the painkiller drug. That slipped my mind. But this is the main raw ingredient for the pain. It just slipped my mind. Sorry, maybe someone can post it. But it's that very famous that many movies came out. But it's the drug that has supposed to relieve pain, but it became a major drug addiction. So that is the raw material, and China is a major exporter. So I think Trump has always complained of China exporting fentanyl into this country. I just slipped my mind the name of that drug. Yeah. Do you think? Okay, I'll leave it to that. Hi Paul, do you think Scott Bassett's 333 plan will work out? Okay, so for those who don't know, Scott Bassett has a is the new trade secretary. I believe so. What he wants is to get 3% real GDP, and then cut the deficit in the US from the current 6-7% to 3%, and then increase 3% additional barrels of oil. I mean, we all can have wishes lah. I also want to have like can I guess drink 3 bottles of wine and not get drunk, sleep 3 hours. Everybody has a 3-3-3 plan, but I really doubt on the budget deficit. And then because if your deficit is 7% or 6% of GDP, if you cut your deficit, that means your GDP is going to go down by 3 percentage points. So I'm not sure where you're going to get that additional 3% growth that you're coming from if the government spending comes out. So I doubt it will work. The additional barrels of oil, 3 million, I don't think you can force it through. Ultimately, it's based on oil price. I mean, you can relax everything, but I think the market not going to drill if the oil price is low. So all this, I think, is just beyond their control sometimes. Of course, I know everybody has a wish. So like I said, want to drink and not get drunk. I mean, everybody wants that. But anyways, why you mentioned higher tariff imposed by US will cause US then staying high? Will the correlation actually? I think that's the observation rather than the correlation, because I think the paper that this Stephen Miran is talking about, the new advisor to Trump, is that economics is all theory. But what he said, that what he's observed is that when Trump raised tariffs, China actually depreciated 15%. And he has the point because China is it's a controlled currency. So I think that's what the point he's trying to say. You can't, and it's true too, because in a way the markets might react, because if everybody's going to be hit by tariffs, and even if there's a trade war, I think US will be on a relative basis will have the stronger growth because they won't be impacted as much as the other countries that rely on the US for US that realize as a major export market. So there is that part of that correlation. Any impact from tariff imposed by US? No impact, because US is technically exporter of crude oil. So and because they import meat, they import. So I think from Canada, I think that's probably the only one. Yeah, but I doubt he will do it on the oil price. I mean, US is a major exporter of crude oil right now. I mean, on balance. Higher long bond yield also signal potential economic downturn. So will it not result in the Fed having to reduce interest rate going forward than negative? It really depends. So higher bond yields or higher bond yields can be either strong economic growth or strong inflation. So it can be either a good reason why the bond yield go up because economic growth is good, and Yeah, and also if there's high inflation. So usually when that happens, then more likely the Fed will raise rates rather than not. Yeah. But why it will benefit the banks? I think it's mainly the yield curve as well. I think Glenn can answer that. Okay, let me just answer one more and hand over to rest. Will Singtel be very negatively impacted from the merger of StarHub and One? Firstly, Singtel should actually benefit because consolidation or less competition. But it really depends what StarHub and One want to do. If they after merge, like I mentioned, they say they want to be the number one, which Singtel is the number one. Then they insist on taking more market share. Then of course, then it's going to be a trade war because Singtel will not give up any market share. So long as there is no aggressive move by StarHub and One to take market share, then I think everyone will be happier, no? Yeah. So don't rock the boat, no? Everyone's on that same boat, so don't go rock it, yeah. Since the profitability already collapsed so much for mobile, then you go and rock the boat and everyone, yeah. Okay, I move on. I move on to the rest. Sorry, move on to the rest. Okay, yeah.
Yeah, thanks, Paul. Yeah, maybe I'll just take on that question. You're talking about the long-term interest rates. Hold on, let me find that question. I think I missed it. But I did talk about the yield curve being like normalizing. So this is basically answering this question which you are asking here is, with your higher yield for long-term 10-year bonds, would this be positive or negative for the bank's earnings going forward? So it's quite similar, where we see that the long term it's now, it's finally overlapping it's going above, sorry, the short term, right? And this is a positive for the banks, especially if you look at the Singapore banks, US banks too. I think that's one of the main reasons why Bank of America did post an increase in their net interest income, where they said they were able to have fixed rate asset repricing benefited their net interest income. Similarly for the Singapore banks, we also believe that this will be a positive going forward. Basically, I'll just recap what I said earlier, where the banks, they will try to take the customer's money and they give a short-term sort of interest, but then they will put it back into the longer term. So that's how they make that spread, right? So for the banks, if the longer term is higher, then definitely that's where they're taking that's where the top line is coming from, right? Their cost is lower. It doesn't change, but at least the revenue on the top is coming from a higher base. So that's how they can get a better spread. Yeah, and so that's how I believe that this will be positive going forward for the bank's earnings. Yes, that's that question. I think that's all for me. Hand it back to the rest of my colleagues. Thanks.
I'll take the Suntec question. In the view that Gordon Tan and wife continue buying in the open market at a lower price, what is the impact and risk to existing shareholders, and what is the chance of privatization at lower price for Suntec REIT? Yeah, so I believe it's just to show like how undervalued Suntec REIT is at the current share price level. It's like more than 40% discount to its net asset value. And that's why the majority shareholder is buying at a very attractive discount. I would believe like they may gradually increase their stake in Suntec REIT, but very unlikely for them to privatize Suntec REIT. And since they did express that it would be better for Suntec just remain the listing status. And if share price recovers, they're just forced to give a offer that is like at the market rate or above the market rate. Yeah, so this will be more beneficial to unit holders. And currently, what unit holders can do is just to vote to reject the offer if they revise the offer price again. And their net asset value is 2.09 and our target price is 1.36. Yeah, and do you think Zixing could become the next oil tech in terms of share price performance? We do believe Zixing has a very big share price upside, especially with their upcoming Hainan project. Yeah, so this is a joint development with City Construction, and that's the second largest company in China. And the project is expected to be completed within 3 years. So the total cultivatable land for sweet potato in Hainan is going to be 5 times larger than the current size in Liancheng. And then Zixing is planning to duplicate the entire value chain from Liancheng to Hainan. So essentially, they'll just continue be selling fresh processed sweet potato and also animal feed by doing OEM and also selling the fresh sweet potato to supermarket and also the wholesalers. Yeah, so demand is almost like guaranteed and stable for Zixing. Meaning the market is like they'll absorb as much as sweet potato as Zixing can produce. Yeah, so with Hainan also have a more favorable climate. Yeah, so they are able to harvest like twice a year compared to a single harvest in Liancheng now. Yeah, so we expect pet meat will at least increase by 5 times upon successful completion of the Hainan project. Yeah, that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Thanks, Mel. Sorry, I think I was at a meeting just now, so I couldn't present. Helena, could you go back to the slide on semicons? Okay, yeah. So this is just an update on US semicons about the Biden's by that it means chip exports rule. So they recently passed an interim final rule on 13 January. So what this interim final rule is about is that it will be immediately effective. It is different from the usual federal rules. So it doesn't have to go through a 30 days 30 days waiting period or any notice. So once it is passed, it will be effective. However, it did state that companies have 120 days to make changes to the rule. So what is in this rule itself? So it stated that there are 3 groups of countries who have varying access to advanced AI chips. So for the first group, it will consist of 18 key US allies, including Japan, UK, and Taiwan. They will have unrestricted access to advanced AI chips. So this makes up a majority of NVIDIA and AMD's revenue, as can be seen on the left. The second group consists of 24 countries under the existing US arms embargo, for example, China and Russia. So these countries will be blocked from advanced AI chips, and there is no change from the current policies. Last but not least, for Group 3, this is the one where the most change comes in. So for Group 3 is all other countries. They are limited to at most 790 million total processing power. This is not a usual metric used in measuring semiconductor. So as estimated by Financial Times, this is roughly equal to around 50,000 advanced chip imports from US all the way to 2027. So for reference, a typical hyperscaler like Meta bought around 200,000 Hopper and NVIDIA Hopper GPUs. So this 50,000 is around a quarter of what a typical hyperscaler will buy in 1 year. So it really limits the other countries from importing advanced AI chips from the US. So last but not least, what this means is that the IFR stated that companies have 120 days to make changes to the rules. And however, even though this rule is effective, it is also possible for the Congress to have a joint resolution called the Congressional Review Act, CRA, to be passed within 60 days from 13 January. So this joint resolution can possibly overturn the IFR. And with Trump coming into office today, there is a possibility that he may make changes to this rule. However, in the case that he doesn't make changes to this rule, NVIDIA and AMD may be impacted, especially in the light blue color revenue segment. However, we don't think they will be that impacted because Biden admin has came out with some semiconductors rule before in 2022 to restrict China from importing chips from US. And what NVIDIA did in response was to come out with a modified version of the H100 Hopper GPU chips. They modify into a H10 chip and they import to China. And they also shift their revenue to other segments of other parts of the world. So I believe that even if this interim final rule goes into effect, NVIDIA and AMD will still have other sources of revenue throughout other parts of the world. Yeah. And I think to answer your question, I think there's one question on do you think Trump will repeal the CHIPS Act? Uh, we think that he's he will try to block out China, but not sure whether he will really go ahead with this interim final rule. So I guess as what I've presented, if he really don't make changes, then there will be a bit of impact into the revenue segments of AMD and Nvidia. Yeah. However, we don't really see this as a very major threat to both companies, as mentioned earlier, because they still have other sources of revenue. I think another question is what's your take on TSMC results? Yep, TSMC recently published their fourth quarter results. They beat their revenue expectations and also their guidance. And I think a very positive note from their results is that they forecasted AI to drive revenue, and they expect close to 20% CAGR in the next 5 years. Yeah, so I think this is a very positive news for companies in the semiconductor sector, because for TSMC itself, their last 12 months revenue from third quarter was the last 12 months revenue growth, was 19%. So if they are able to forecast this 20% growth for the next 5 years, I think that means they are expecting this strong trend in growth of semiconductor revenue to continue. And this is a major advantage for companies in the semiconductor space as well. Yeah, I think that's all the questions for me now. I'll hand over to my other colleagues. Thanks.
Yeah, I'll take over the TikTok question. So in your view, what would Trump do with TikTok? I think Trump's overall response to TikTok is just a little bit interesting. On one hand, he's the one in his first term who kind of initiated the whole thing. So you do see a pretty clear conservative case for banning TikTok, because all he did was trying to reorientate a lot of the foreign policy around. So you definitely can see him saying we need to crack down this app for national security reason because it's owned by a foreign adversary. But I guess on the other hand, he can also tell how unhappy the US citizen already is. It's just, I think right now what he's trying to do is it's more like a political move, because he can tell it's politically very, very unpopular, especially for him, who's very popular among the young voters. So he understands that taking something so popular away from voters is definitely bad. So if there's any case, if he can come off and seen as the person who's the savior of the app, he would definitely be rewarded. So I guess right now what he's trying to do is really to strike a middle ground where eventually the app, he tried to get it to stay, but somehow strike a balance between how is it not going to affect national security. So yeah, that's what he's trying to do. I see another question about whether Google would be still prop for antitrust under Trump. I think he will likely dial back a little bit because recently he did an interview where he was asked about whether there would be a potential break up of Google, and in which he said, I'm going to ask myself whether it's actually going to destroy the company, because what we can do actually is without breaking it up, but making sure it is more fair. So I guess it will still be on his radar, but he's gonna try to dial it down to like more mellow tone, just so eventually the company itself is not going to break up. I guess it largely resembles to Microsoft in the 1990s, where the US government also tried to break it down. It took several years, but finally they managed to appeal, and just eventually the case was dropped. So I guess he will still be on it, just not so aggressive. But even if that's the case, it's still going to take several years for the effect to actually kick in. So that's all from me. I'll pass my time to Darren.
Yeah, okay. I think we can just move on to Zane, but before I hand over, just one last question from to how will Trump 2.0 be different from Trump 1.0? Okay, there's one other upside that we never really mentioned, because if we talk about it, it'll be so ridiculous, nobody will believe. So one other upside potential is under Trump 2.0 is that if there is really lack of better word, world peace or geopolitics suddenly swing to the other side. So there are some signs of it. I know when he was Trump 1.0, no, he even met with the North Korea. So, and you already see there's already peace coming out in Gaza. So if you do a scenario where you actually see geopolitics really come tamed or become really much more peaceful, then I think that will be another positive catalyst for US for global equities. And of course, it'll be bad for gold, defense, and even bad for oil price. So that is one thing, but of course we don't really mention it because nobody's going to believe it anyway. So, but that will be one major difference to watch. If real geopolitics really wind down, Ukraine is settled. He actually doesn't ban TikTok, relations with China turn more positive, then the geopolitics worry could actually subside, and then the market could rally off that too. But anyway, let's move on to Zain.
Thanks, Paul. I'll move to the TA questions. Yeah, so let me just share my screen. Yep. So okay, first question is on the three local banks. So I think first I want to talk about DBS. I think recently a bit of slight weakness is just if you look at in terms of the trend line, it's coming off under this for around the 43.80 to $44 support level. So I think for the short term, I think we might see a bit of sideways trading. I think this 42.80 to about $43 level will still likely hold as support. So I think we just see a bit of sideways trading for a while over here with short-term resistance above like 44.20. Then next one is on UOB. So for UOB also just quite sideways recently. Price has just come down below this $37.30 level. Yeah, so I think generally it looks like to be trading within a rising wedge itself. Over here in blue. So I think for now the support around 36.60 will still likely hold as support. So I just expect a bit of a sideways consolidation as well. And then for OCBC, I think overall is still one in terms of the charts, it's still one of the best, I think, as compared to the other two, because we're still seeing higher highs and higher lows. And recently this retest of higher resistance around $16.90 is still holding as support. So I think this will still hold as support. I think we might see a continued bounce ahead. Short-term resistance around 17.30 to about the recent high close to 17.60. Okay, then next one's Wilmar. For Wilmar, I think nothing too much. I think it's just been sideways consolidation for quite a while. Yeah, recently still holding support around $3, but resistance around about 3.13. So I still expect just sideways consolidation. And for Escort, for Escort, I think also quite sideways, range trade between like 87 cents to 90 cents. So I think that will still continue for a while. Yeah. Then above 90 cents, the next resistance about 92 cents to 93 cents area. Next question is on CDL Hospitality Trust. So CDL Hospitality Trust also in the range bound for now about 85 cents to 89 cents area. So I think we'll still likely trade sideways for a while. But 89 cents, the next resistance level is around 91.5 cents. I think for sets, this question is on sets. It's also in a bit of a consolidation for now. The key support level to watch will be this around 355. That will still, I think that will still hold for a while. But but in terms of recent times, just a bit of sideways with slight weakness as lower highs have been formed along this downtrend resistance line. So I think for now, probably a sideways consolidation between 355 to about 365 area over here. The next one is on SIA. Yeah, for SIA, I think for now, a bit of a slight weakness recently, because of from this trend of higher highs and high lows, we've seen a bit of a weakness since it broke below this 640 level, lower high being formed and lower low as well. So I think if price does actually break below like about 630 again, I think we could see some slight weakness ahead in the short term to maybe retest this next support level around 620 over here. And next question is on Mapletree Logistics Trust. So remember MLT, I think as with most of the REITs over just now is also in a range trade between 125 to about 132. So just doing a bit of a rebound from near this support recently. So I think we still likely see a bit of a range trade continue for now. Yeah, then above 132, next resistance about 136 level. In this question, Far East Hospitality Trust, I think it's also a bit of range bound for now, or at a confluence of supports around 60, near the 60 cents mark. So it's a horizontal support level over here, as well as when we look at the longer term picture, is also the rising wedge support recently. So I think we'll probably see some rebound from this area. But I think resistance will still hold at the recent levels around close to 63 cents level. Yeah. So I think we just sideways between 60 cents to 63 cents. Okay, next one is next question is on Penn United. So for Penn United, I think the uptrend is still intact. Just a bit of a range consolidation recently, but positives is that this previous resistance area around 53 cents to about 55 cents has turned into a support, is still holding, and we are seeing higher lows being formed. So this is like an ascending triangle over here. Let me just highlight it. So with the resistance, neckline resistance at 57 cents. So I think we might see a bit of a consolidation still over here, but if it does break above 57 cents, I think we could expect more upside, continuation of the bullish trend ahead. Then for next counter is Dayang from Bursa. Yeah, for Dayang, I think looks like there's a bit of a false breakdown recently below the key support around $2. Price has rallied these past two trading sessions. I think we could see some further upside hit to retest this swing high resistance between 227 to about the 237 area over here. And before it might just do a bit of a pullback thereafter. Yeah. And also looking in terms of this downward resistance line, looks like if it can hold a higher low over here, like let's say like above 210, then I think we could see some a breakout, this breakout holding and price going towards higher levels. Yeah. Okay, next question is on Novo Nordisk. Yeah, for Novo Nordisk, I think still continuation of the weakness. So it's just been range trading since this gap down that occurred end December. But recently broke below this support level around 82, around 82.70 about there. So I think we could still see some further downside here. Continuation on the downtrend towards next support levels previously was around the $76 mark, and then below that, next key support level to note be closer to about $71 for Novo Nordisk. And there's also a question on Mapletree Penn Commercial Trust. So for Impact, also as we move on, just range bound between about 119 to 125. So I think there's a bit of rebound from this support recently. So I think, yeah, it might just continue in this consolidation. Above that, next resistance will be around $1.30. Okay, yeah, okay. There's a question on what's your view on Visa and MasterCard. Okay, I think we don't cover it fundamentally, so I'll just give my TA view on it. So for Visa, I think it's just been doing a bit of a range consolidation for quite a while since start of November, between about $300, about 320. So I think nearing the resistance over here, we might see a pullback again. over here, as it looks like it's still just kept in the room, this consolidation for the time being. Then for MasterCard, now MasterCard also just range bound between about $500 to about $535. So recently, a recovery back above this breakdown level around 518. So I think if you can hold over here, we might just retest this resistance again, then just do another consolidation over between like 518 to 535. Okay, then assume some of the questions key for SGX. Okay, for SGX, I think we're seeing a bit of a weakness for now. This lower highs, lower lows from here, previous support around here, around 1260 turned into resistance, and following which there was a breakdown of this support around 1220, now acting as resistance as well. So a bit of a slight down, a bit of a pullback taking place over here for now. I think we might still see maybe some further weakness if it does break below this recent support around $12. Then next key support over here, I think will be around 1160 for SGX. Yeah. So I think we might just see continued a bit of weakness for the time being. Okay, then there's another question on Singtel as well. Yeah, for Singtel, I think still nothing too much, just has been range bound between this $3 to about 317 for quite a while since October last year. So I think for now that will still continue unless there's a breakout above like $3.20 about that, then perhaps it could retest the swing high over here around 330. Yeah, but for now I think just still continue in this consolidation. Yeah, so there's also a question, how do I join this trading investment? Do you have an official link? I think, yeah, we don't have any trading investment or links. Yeah, just to clarify. Okay, I think that's all from me for the TA question. I'll hand my time to my colleagues if they take the other questions.
Hi, I think there's a question. Is Singapore in the group one for UI's AI chip export? Yep. Based on my slide, group one refers to key US allies, the 18 countries, and Singapore is not one of them. Singapore is part of the group that the rest of the world part of the group. So they will also be capped at an estimated 50,000 advanced AI chip exports. Yep. Thanks.
Yeah. Okay. Let me just wind it up with some of the remaining questions. Paul, what are implications of U.S. Treasuries staying high on stocks or all gold commodities like palm oil? It generally negative. I think if it's it really depends. Because if the treasuries are rising because economic growth is so strong, then for all the if the treasuries go up because of growth, then it should be a boost to all the companies involved. Yeah, to all the commodities involved. Yeah. So sorry, I'm having some technical issues. Yeah. Your view on Singapore market for the first quarter, up, down, please elaborate more on the answer or you pick up. Yeah, so we are positive on the Singapore market in the first quarter. I think the results will be strong, especially from the banks. And of course, everything will hinge on what Trump says, I guess, tomorrow morning, Singapore time. But we're generally positive. Again, like we mentioned, we think he'll be more benign on China, and anything that benefits China will also be beneficial for the whole market here in Singapore. I mean, just our general view. Okay. There are some other questions that I typed. Some ask, how do you identify privatizations? The problem is you can identify privatizations because it's cheap and all that, but the timing is impossible. Like Great Eastern, maybe you may have known that Great Eastern was cheap, but who would have known they would have privatized it last year? So the timing of it is always very challenging. I'm going to leave it to, I think there's some news by Darren then for Darren to kind of close it up. There's two questions on REITs and then one on CDL property, and then I think Darren, you can close it up. Thanks.
Yeah, so there's one on more than 1K HDB sold more than 1 million so far. No indication of percentage of Singaporean PR pay such a high price. Looks like with small percentage of foreign investors come because of BAC. Yeah, you're right that the foreign investors have basically they really vanished really because of the 60% ABSD. And for HDB, right, because it's a public so there's basically foreigners they can't buy HDB unless they marry a Singaporean. Yeah.
Probably the downgraders are pushing the market to maybe. Yeah. From private.
Yeah, that as well. Local take-up seem to be able to continue this as super. Not sure whether I'm able to keep my job with the high price with so high. Yeah. Not sure whether I'm able to keep my job to eventually pay up my load for such a high price with so high service charge, which keeps going up. Yeah, so property the service charges are yeah, that really depends on the condo that you're staying also. Yeah, I can't really comment on that. Sorry. Yeah, please comment on ESR logos. Yeah, so for ESR logos, I'm not too familiar with them. But for them, basically they're still showing some good positive rent reversion. They did some acquisitions and divestments also, portfolio reconstitution in 2024. And rental reversions are about at 9%, so that is quite strong, led by mainly the logistics sector as well. Yeah, but the drag is still the business park sector, which is like 2% rental reversions. Yeah. And ESR logos, they also started to experience some improvement in cost of debt. So the cost of debt started improving was lower in the third quarter last year as well. So it's at 3.96%. Yeah, the share price, maybe can leave it to Zin. There are still quite a few TAs. Not sure whether Zin just take a few since we have like 2 more minutes.
Yeah, sure. I can take.
Yeah, thanks.
Thanks. Yeah, so I think I still see some questions. First one I think is Thai Bev. So as for Thai Bev, I think we're seeing still a bit of weakness recently because this seeing this 56 cents level supporting your resistance over here with lower highs, lower lows. I think with that also recently broke below this 54.5 cents level. So we might still see some weakness ahead. The next key support will be around 52 cents level. Yeah, so I think we might just continue a bit of a pullback recently. The next one on HST, which is the HST is the Lion OCBC HS Tech ETF. So I think for this, it still looks like a bit of range bound recently. So just rebound from this support level around 71 cents currently it's about 78.6, and so I think we might still see a bit of a slight upside to test this resistance zone over here around 80 cents, 80 cents to about 82 cents area. Next one is on iFast. Yeah, for iFast, I think a bit of a retest over here recently, but retest of the support breakdown around 740. I think this will hold as a resistance for now. So we might just do a bit of a pullback from here to just range trade, with support holding around 720 around there. Given that still seeing there's still like overall weakness over here with this ongoing since it's middle of December. Yeah, when price pullback from about 790. The next one is on Capital DC REIT. So okay, Capital DC, I think is likely to be in a range bound still around 210 to about 230. Yeah, it's just holding in a range since quite a long time, since October. Yeah, so I think we might still see a bit of a bounce from here towards a resistance around 228 onwards. Then we might see a bit of a pullback taking place. Okay, the next question is on 9992, which is PopMart. Yeah, so for PopMart, okay, let me just draw the lines first. Yeah, so I think for PopMart recently, the rally has stalled a bit. So previously, yeah, we had this rally over here. It's turning into a sideways consolidation. I think this support over here, 82, is still holding. I think we could see the price go on to do a rebound to test the resistance around 96 again. So I think this consolidation will take place for a while for now. Yeah. And then there's two more questions on Digital Core REIT and okay, first question, Digital Core REIT, I think overall still a bit of a range. Recently it looks to be a breakdown of the 57 cents level. But yeah, just doing a retest, I expect this 59 cents area to hold as a bit of resistance over here. Particularly when there's first like a breakdown that took place over here at start of December, then the retest on resistance, and following which it continued the weakness over here. So over here, I think this resistance will likely hold. So I think yeah, price will face a bit of a pullback from this area. And the last question is on TJ Darentang. For this, I think there are still weakness with the trend of lower highs, lower lows. Recently, a bit of a slight rebound from near this support around $2, but I expect this support breakdown level around 210 to pose a bit of resistance. So I think you might still see a bit of a pullback take place to maybe retest the recent lows around $2 from this current area. Yeah. Okay. Yeah, if you have any more TA questions, you can feel free to join I'll be doing a US TA webinar tonight 8 to 9:15. So if any more, if you have time, you can feel free to attend and ask TA questions over there as well. Yeah, thanks. I think with that, I think I'll have more time to Paul.
Zane, I think can just
Okay,
close it.
I think yeah. So I think I'll just close off today's session. Thanks everyone for attending today's our webinar. Yeah, hope to see you all again next week. Also, feel free to join our corporate insights webinar. I think we have for this week we have OUE read on the 24th lunchtime. Yeah, so feel free to attend. Thanks. I hope hope to see you all again next week. Bye bye.